Go recording. Okay. The workshop is being recorded now, and so just make sure that so you don't jump in with anything you might regret, like talking about how certain public leaders sort of deserve to be hung in public or something. Away we go. Okay, welcome to week 7. And here we're going to be going on with more of this number stuff and the capital budgeting analysis. Really what we're doing is applying the capital budgeting to, the mathematics that we did in first week to the question of capital budgeting, which is pretty central to business finance. If you're taking a role of being a financial officer somewhere in the finance department of even a smallish company, this is the sort of analysis that is very, very important. Once you've done a bit of it, it's not hard, but it's there, okay? And it does look a bit kind of creepy. So that's what we have to lock horns with, and hopefully we're working through it. You know, a fairly gentle pace, I hope. You know, I know that the PowerPoints are a bit overwhelming with 70 plus slides in a session, which obviously no one can get through. However, they're there really as an alternate set of study notes. And so that's their real purpose. And so just be aware of that. While we're talking about introductory things, I want to just bring you up to date or talk to you a little bit about the exam. In my spare time, just for something to do, I've written out the exam paper, which most of you kind of expect to have kind of pop up. We're going to be doing that as an take-home paper because of the corona disruptions and so on. And so that's going to be available during exam week. The actual time and the weight and length of time that you're going to have to sit it is all going to be revealed as time goes on. Notionally, it's meant to be parallel to a formal exam. So there will be a window of time, there will be a time set. I'll actually be giving you more time than you need. You know, if it was a regular sit-down exam, you would be going along to some place physically, sitting there for 60%, 3 hours, and then you go home and go down the pub or whatever you're going to do after. Here, not quite so comfy and sociable. You don't get to spend 3 hours looking at a piece of paper and sitting in a room of people that you're not allowed to talk to. You're able to do that at home. But we're probably going to be more interested, or you guys are going to be more interested, I suspect, in what's in the exam paper. And people from time to time ask me, you know, give us a few hints, you know, which chapters do I really have to study? Okay. And officially, we tell you that in 3 weeks' time, in week 10. However, I'd like to preempt that a little, because after I wrote out the paper, I was talking to some colleagues, and I was reminded that not so terribly long ago, I used to write exams in a slightly different way. My experience has been that students like to know what's in the paper before the exam. Obviously, it makes it easier to focus your study. Lecturers tend not to tell them, and so there's a certain amount of tension there. Some people would say it's healthy tension. I won't get into that argument. However, I have been using an alternate approach on some classes. This is how it works. What I offer the class is to give them the exam paper early, or at least the exam questions. Currently, sitting on my computer, and some of you enterprising folks might want to organise some cat burglars to come in and steal it so you can get a bit of a pre-read, but it's sitting on my computer. There's 12 questions written. Actually, no, there's 11 questions written. Now, 11 should be a magic number, and I'll let you work out why there are 11 questions. But there are 11 questions. They cover the entire of the syllabus, the curriculum, if you like, for this unit. 11 questions. Each one has a same value, and each one will require a bit of an essay. when I looked at the assessment, I thought, well, in the first assessment, it's hardcore maths. Second assessment, not very much different. Different maths obviously being tested in the second assessment to the first one, but basically it's a mathsy kind of assessment you're doing. And I thought, well, you guys are probably just about quizzed out with mathematical calculations, and we haven't really attended nearly enough to theory. And so I thought, well, the best way to do the formal exam, the final exam, is to have the final exam on theory, which is really, really important. And that way we can let the assessments, the intermediate assignments, focus on the maths. And that, to a certain extent, is meant to take the trauma out of it for you, and that you can sit back over a period of time. I think you've had the current assessment that we're in the middle of, assessment one, assignment one, now for some time. So, you know, you can look at the textbook and scratch your head and talk to your mates and all the rest of it. And it'll be similar for the second assignment, second assessment. But there's no theory in it. Where am I getting to that? Okay, so we won't do maths in the final exam. If we did find maths in the final exam, since it's take home and, you know, you can talk to your mates and all that sort of carry on, obviously we'd be using the same kind of data strategy that we've done with the first assignment, which is everyone will be getting their own data, so you can't, you know, borrow other people's work. But the final exam will devote to theory. So it's an awful lot in the slides. Typically, as we go through the slides, you probably noticed I'll be sort of saying, you know, this is what I'm going to talk about, and I'll talk about that. And I said, well, just read those slides, and we kind of move on. I also ask you to read the textbook. The final exam is going to really be focused on all of those slides that I don't cover in class, because in class, I am concentrating more on the mathematical skills, because I see those as the issues, the parts of the unit that benefit most from having a live body talking to you and actually showing button presses and whatnot. And so that's why I run it that way. I would dearly love to talk more about the theory. However, there's, you know, a certain amount of content, which I think you probably noticed in the course. And I also find that to a certain extent, the theory side of it isn't really heavy-duty theory, like trying to get your head around some physics relationship or something. It comes down to the sort of common sense stuff that people with a bit of common sense involved in a business environment would actually pick up by the seat of their pants. And by that I mean, remember in the first week we talked about different business structures. Well, that's exactly what you would find if you started off, say, as a plumber. Okay? No business school at all. You do your trade, you learn how to fix pipes and put in toilets and do all the other wonderfully, extraordinarily important things that plumbers do. And then you go off and decide to become self-employed. Now, the plumber is not going to go to business school to go and work out how to fix people's toilets. And really, it's just a matter of working out quotes and maybe go along to an accountant to get it all sort of tidied up for the tax man. But he's going to be asking a lot of these same questions, if you like, that you know, we ask in this unit, and you'll be finding the same answers. As that plumber becomes more successful in business, he might take on a partner, and so his business structure will change. Later on, if he becomes fabulously successful, he might employ a whole bunch of other plumbers and find it useful to run his business through a corporate structure. And so he'll basically work his way up through those levels that we talked about in theory in the first week. Why is this important? It's important because I want to drill home to you the fact that this is a lot of learning about facts, but a lot of the facts are not hugely complex. They're the things which your average plumber, and I have a lot of respect for plumbers, and typically they have a lot more sense than a lot of graduates, unfortunately. The typical plumber will be able to work out in the simple, practical business of running his business. And so what we're aiming to do at university is actually speed you up into understanding those things. And it is really as easy as reading the book. So that's kind of the background. We need to get you reading the book. We need to have you graduate from this unit confident that you have read the book, understand the common sense stuff. So if you go down to a party and meet one of your mates who left school at, I don't know, year 10 and went off and became a plumber and, you know, is now sort of employing a couple of apprentices or so, you'll be able to talk to him about the business finance you've learnt, and he'll be able to say, oh yeah, that's what I'm doing. I bought myself a shelf company last year, and it's a better way to run my wages and get my BAS returns and all the rest of it. Okay. So that's the deal. Theory. Theory is important because you will be taking a lot of ideas a lot further than the average plumber will be running in his business, but not anything more complicated than what you find in slightly larger, more complex businesses and the way they operate. Okay. As far as applying that to the exam goes, I say, right, currently I've got these 11 questions sitting in my computer. And of those, when the exam comes up, they're actually, well, I'm thinking of 2 different ways of presenting them to you. Okay, here goes. The easy, straightforward way is to get to the end of the term, get to exam week, have a day and a time when the exam becomes available. You open it up, sight unseen, and I ask you to answer 6 questions that can be taken partly from a couple that I choose and partly from a couple that you choose. And so I might give you 2, 3, 4 compulsory questions, and then allow you to choose whatever it takes to make up to 6. Okay, that's one way of doing the exam. Okay, and that's not surprising. It's the sort of exams that you've done before. Another way to do it, we take those 11 questions, give them to you maybe next week, and let you look at them and read them and think about them. Maybe do your revision from what you've done in the past, and also your study to the units that we, or the weeks that we are going to do to the end of term. So you actually have your questions well and truly beforehand. Now, what's the advantages of that? The advantages is that it reduces your stress. It gives you a track to run on, because you can say, what do I need to know out of week 1 or week 3 or week 7 or whatever it is in order to answer question X, Y, Z. And so you can do your study in a focused way. You've got the comfort of knowing that you know exactly what the exam paper is going to look like as far as questions go. Okay. And then when I give you the exam paper, you know, in the exam week, you'll be able to say, oh, I've already got all my answers worked out for this stuff. I'm on top of the whole unit, because my job is to get you guys to learn the unit and be good at it, so you can work well in either consultancy or private practice, working in organisation. Okay. And giving you the questions beforehand, I think, has a lot of advantages. Has one disadvantage, and that is that if I give you the 11 questions and say you only have to do 6 of them, what that means is that you guys could only conceivably do your revision on half of the unit, which obviously would not be a good way to encourage you guys to learn the whole unit, because everything in the unit is very important. Okay. So to get around that, what we're going to do, or if we take this strategy, is say there are going to be 11 questions. You'll get to read them, think about them, even prepare your answers for them well and truly in advance. And when we get the paper, there will be a number of them that I will choose, and they'll probably look like, well, in fact, the numbers we're going to sort of talk about, but most of them. And so I look either like taking those 11 questions, allocating 20 marks for each one, getting you to do 3, because remember it's worth 60%, where I'll choose 2 of them and you'll choose the 3rd one out of the remaining 9 questions. Okay? So it really means that if you want, you can prepare your answers starting as soon as the questions become available. And when you do the exam, some of you are kind of concerned about whether this computer is going to work on the day, whether you're going to be able to get time off work, all that sort of stuff. But if you're able to have your answers prepared ahead of time, a lot of those practical problems, you know, to do with just the physics of that, the physical side of access will disappear, because when you actually open the exam paper and you find that Small has said, you know, questions 6 and 8 are compulsory, and you can pick another question from anywhere out of the remaining 9, you'll probably just pull those files out of your computer, slot them in. 10 minutes later, you're down the pub with your mates having a beer and relaxing because you've done the finance exam. Okay, so they're the 2 possibilities. One is sight unseen, get to the exam, and I will choose some, probably 2/3 of them, and that'll probably look like 6 or 4 out of the 6, and you can choose the remainder, so another 2 out of the 6, or we can do publish the exam questions, and we mark the questions out of 20, and so obviously for 20 marks you'd be expecting a more interesting answer, the sort of thing that you would probably be able to knock up in about 40 minutes and under exam conditions, because remember, this is anyway, it's kind of proportional to that, and away you go. In the past, when I've given classes the offer of which style I would like, sight unseen, and do a lot of questions, or with the opportunity to see the questions early in term, get the preparation going, and then have a smaller number of questions, some of which are chosen by me, some of them are chosen by you. I've had something like typically about 80 or 90% of the class just about always vote for the, you know, let's see the questions early kind of option. And generally, my experience has been that the students tend to perform at least as well, usually better, and they're usually a lot more relaxed and a lot happier with the outcome. The only complaint I've ever had from students, by the way, and I've been running exam papers like this now for years, over a beer Christmas party, we used to get all our students together for end of year drinks when I was teaching on campus. And I remember one of the students, we were talking to a little bunch of people, and one of the students said, "Yeah, I really liked that exam, but it made me study more." And I thought, well, there you go. That sounds pretty successful. Study more, that's the downside. The other side is it's a really great way to do an exam because, as I say, it's really low stress on you guys, and it'll help you come out confident that you've known the unit really, really well, which makes me happy. Okay, I would like all of you to be able to be so confident in this material that you can do my job next year. If I get you up to that stage, I'll be a happy boy. And you guys will know that you're very employable in this area. Okay. You know, the realities are that not everyone sort of takes that opportunity, but it's there for you. Okay, what I propose to do is I'll prepare a little SurveyMonkey survey, and during the next week, I'll flick that around, and hopefully before next Tuesday, I'll have enough people taking the trouble to do that little survey. It'll basically say, which style of exam would you like to do? And if I get a clear majority, not 51%, but a clear majority, let's say 2/3 of the respondents saying, yes, let's give me the exam questions, then we'll go that way. And if we don't get a clear majority, then we'll just do the ordinary way. I see it as a great advantage for you guys, but I'm not going to insist on it because, some people might say, oh, that's really scary. And I don't want to put anyone in a psych ward because, been psychologically damaged as a result of some alternate form of exam structure. Okay, so give that some thought. As I say, the Survey Monkey survey, I'll knock that out before the end of the week. And I would really appreciate it if you take the time, and this will be an extraordinarily easy survey. I'll only have 1 or 2 questions in it. If you can just spend a minute or two to go and flick that back to me, I'd really appreciate it. And it'll really help the class as we decide which way to run the exam. And so you could be seeing the exam paper as soon as maybe next Monday or Tuesday. Okay, that's the plug, or at least that's the promo for the exam. While we're talking about that, I'll just start. We're in the second half of the term, right? This is week 7, and so we had 6 weeks, which is first half, another 6 weeks, second half, and away we go. I just wanted to get you to think about a couple of things as far as study goes. Remember, I said just a couple of minutes ago, my goal is to get you guys so enthusiastic about this stuff and so learned in it that you can do my job next year. And I'm not kidding with that. It's now getting to be a couple of years ago, which you'll probably be able to spot the sort of number of years it might be from the colour of my beard, where I was an undergraduate, where I was learning the sort of things that you're learning today. What's the difference between you and me? Well, yep, I learned it, got myself a job as a university lecturer, and then I suddenly discovered that I had to teach the stuff that, previously I was kind of sitting in the back row, back in those days, chewing bubblegum and thinking about going down the pub with mates. But this is serious stuff. The purpose of coming to university isn't to spend time and amass a huge HECS debt or, get your family to pay huge direct fees or however it is that you come to find yourself here. The purpose of being at university is to take an opportunity, a very special opportunity, to learn some pretty grown-up stuff. In this case, the material that we're going over is extremely important for your financial lives. Maybe because you might apply it in business, and that way you'll get a nice salary as a result of being really good at this stuff. Or maybe you might apply it to your own business or your own investments to make yourself really fabulously wealthy. Or maybe you might do both, and a lot of people do. Okay. So this is grown-up stuff, it's important. It deserves your attention. Now, occasionally I find myself kind of, not exactly looking over the shoulder of folks, but, you get onto sort of random conversations here and there. And I think back to when I was an undergraduate, and I probably wasn't the best of examples as an undergraduate. And so I guess as a result, I've got a pretty good idea of all the mischief that university students get up to. And I've largely lived to regret it. And so I don't recommend it. I did spend an awful lot of time at the bar with my mates, coming in late for class, leaving early, and leaving cramming until a few days before the exam. And I know the stress that causes, and I also know that it doesn't help you when you move into professional life. And if I can discourage you from doing that, I think that will be me doing a service for you guys. Despite the fact that sitting at the bar and coming in late for class and, raging around sort of late at night is a lot of fun when you're a young person. Okay, I know that. Young people tend to think that old people don't know what it's like to be a young person, but if you just kind of think through the logic of it, all of the people with grey beards have all been young once. We've made all of the same mistakes that young people do today. There's not really that much interesting new mistakes that people can make these days, as much that you tend to think that way. But I do really want you guys to get the most out of the unit. Having said that, I'm going to say some really boring things, because now as we're getting to the serious part, I want you to think about what you're here for. I don't want you to end up with a HECS debt and a fail. In fact, I'd even prefer if you didn't have a HECS debt and a pass. And the reason is that to make the HECS debt worthwhile, I'd prefer for you to be getting a credit or a distinction or a high distinction. That's good value for money. You know, you imagine sort of going down to the shop, you know, to, I don't know, buy something important, buy yourself a nice motor car. And you go in with, I don't know, $30,000 in your pocket. And someone says, oh, here are two cars. This one's got one wheel falling off, and the seats are ripped, and someone's kind of, you know, put sand in the engine, and we'll sell it to you for 30 grand. Here's the same make and model, and it's been owned by an engineer who is very fastidious, has kept it in really immaculate condition. He was married to a woman who insisted on it being sort of garaged and polished every weekend, and everything inside it being sort of squeaky clean and looks like absolutely brand new, even though it's 5 years old. Two identical cars, same make, same model. One's rag and hardly goes. The other one, same make and same model, absolutely showroom condition. Both of them are going to cost you 30 grand. Which one will you choose? Does that take very long to work out? Okay. Apply that thinking to education. You're going to pay the same amount for coming along to do this unit, whether you apply yourself or not. And when you drive out of the showroom, when you finish the exam, right, do you want to have an education that looks like an absolute showpiece, or one that looks like the wreck that really should be sort of taken down to the dump? Okay. It's up to you to decide. And the decision has to do with how you spend your time, and to a certain extent, a little bit of money. Notionally, to study at university, each one of our units has a level of learning in it, which is 6 credit points. That 6 credit point number isn't simply a number that some, I don't know, vice chancellor kind of dreamed up. It's actually taken from a system of measurement that was developed in the United States, where all of their units, their subjects, if you want to call them that, ran for a full year of study, which in the United States was 26 weeks for universities. And the 6 credit points meant that there was 6 hours per week for every week of term, which in those days was 26 weeks, through the time you'd study that subject. And so that's what 6 credit point meant. If you did a 2 credit point subject, it means that there was 2 hours of study for every week of the 26 weeks of the year. That system was brought into Australia, and we tended to compact our units. So instead of stretching them out over 26 weeks, we've actually really delivered them in 12, so about half the time, a tad less than half the time, but we won't worry about that. And so 6 credit points means not 6 hours of study per week for all of the weeks of term, because it's been compressed down to half the length of duration. It means 12 hours of study per unit, per subject that you're studying for each week of term. So that means that you've got 12 weeks of term, 12 hours of study of each week. That's 144 hours of study for each unit that you're studying. That's what a university education is based on. And so when we have these sessions, these workshops, you've got 2 hours of workshop. But I've just told you that this week, to get good value for your HEX dollar, or for your enrollment admission dollar, you should be spending 12 hours studying. 2 hours in the workshop only takes care of 1/6 of that study time. The rest of the time, you're on your own. That means you can be in your book, you can be looking at the notes, you can be working through the exercises, you can be going through the PowerPoints, maybe working on your assignment, maybe revising and getting ready for the exam. Anything you like, so long as, on average, you spend 12 hours a week studying. Okay? A lot of people will say, oh, goodness gracious, I thought Small was a kook. Now I know he's an absolute crazy man. I don't have enough time to spend 12 hours a week studying business finance because I've got a job, I've got a family, and I've got a whole lot of other study to do, and I've got my mates. Right? The choice is yours. You'll spend the same amount on your tech stack, regardless of what choice you make. Okay. The other question, or the other point that I'd like to make briefly, is that about now, starting to think about, you know, all of that stuff that you need to understand in order to get to the exam and also to do the assignments and so on. And there's a little matter of, you know, I keep talking about this textbook thing. I can't tell you to buy a textbook. And I don't get a commission from Pearson or whoever it is who publishes the one we're using from this course. On a quiet moment, I even tell you I don't like the textbook. I think most of the words in it are very good, but I was reading it over this morning and I was thinking, oh my goodness, it's a lot easier to read if I could only sort of blot out all of these pictures and distractions that are in the damn thing. I think that this chapter, doesn't it sort of start with a great big half-page kind of photograph of a packet of potato chips? I mean, get over it. You know, we're learning finance. We're not kids in sort of sesame school sort of needing to be entertained. So there are things about the textbook I don't like, but the words that are in it, absolutely gold plate. And they will turn your, you know, the $30,000 wreck into the $30,000 sort of showroom condition, something you can be proud of, basically by reading it. And so I do recommend that you do read it. And you don't do what I mentioned earlier I used to do when I was an undergraduate, which was leave my reading up until the night before the exam or something, or the week before the exam, because you simply won't get in the old brain box, right? Drip feed yourself. It's a far better way of learning. And so allocate at least some time every week to be up to date. Because if you get into week 6 or week 4 or something, and you really just haven't opened the textbook yet, then not going to work, right? And my job is to get you to be able to do my job in 12 months' time. Right? So read the textbook. If you haven't got the textbook, think very, very seriously about getting a copy. You can get it as an online version, which is a lot more affordable. I still have textbooks from when I was an undergraduate, and occasionally I even read them. So these things are things which will be useful for you for a long time to come. But now is the time to be really getting your nose into them. Okay, and that's the best preparation. And it disappoints me a little bit when I get emails, and you're most welcome to, you know, it's honest, I guess. Not necessarily in this unit, but in other units, I'll get an email every now and then from students. You know, you get up to week 6 and someone says, well, I've been a bit behind with work and I haven't actually been able to, you know, do this. This assignment is due next week. Can you tell me what I've got to learn for it? And I'll, hello, you know, we're in week 7, week 6, and you haven't opened the textbook yet, and you haven't watched any of the recordings. How are you going to get your 144 hours up? Okay. So why am I telling you all that stuff? I can't tell you to buy the textbook, but I reckon it's really stupid if you don't get it, because you've got to find some way of reading it, and that's really, really important. And in a certain sense, the $1,000, $2,000, whatever it is, dollars that it costs you to go and enroll in the subject, if you say, well, I'm going to save money by simply not getting the textbook, what that means is you're basically throwing literally thousands of dollars down the drain for a saving of whatever it is, $60 or $80. So you can sort of work out the benefit cost ratio of that. Also, get in and do it, spend the hours, because right now that $1,000, $2,000 that you're spending, it's so that you do learn this stuff, right? But it's all your decision. You big boys and girls, I can't tell you. But on the other hand, if you don't take the opportunities, you haven't been told. It's not because you haven't been told. Okay. Right, now.
Sorry. Before the class call, I'll ask you a question. Yes. About the quiz, the quiz include the series or just the math?
Say again?
Does the quiz include the Serious or just the quiz?
Does the quiz include the something or just the quiz?
Serious. See, the concept.
Oh, does the quiz involve the theory?
Yes.
Yes, it does. The quiz, the next part, is a bit more. It's got sort of two elements to it. It's got numbers and some theory. It'll be done through Moodle. Does that answer your question?
Yes. So it includes both concept and math.
Yeah, yeah. In fact, you'll even find the maths a bit easier because it's done through multiple choice, which some point in the near future, you guys won't have to worry about it. But I think asking mathematical questions in a multiple choice format is a bit silly, but that just happens to be the way the thing's set up, and I didn't set it up. So, you know, it's like asking you what's 3 times 2 and then giving you 4, 5, 6, and 7 as the possible answers. So that's what you're going to be exposed to. Okay, let's get in and look at what we're actually doing this term, this week now. I'm going to share the screen. We'll go to screen 2, we'll share it. So you should be looking in on screen 2. Okay. I'm going to start by simply showing you something. Now, I think I'll put this up in the Moodle site. It's a diagram I use for a different unit, but I found that in talking to a number of students by email, privately, what have you, I keep sort of saying to people, the way to solve such and such a problem is to start off by building or writing out a cash flow diagram. Now, this diagram just happens to be an example of a cash flow diagram. What you draw, or what I'd like you to think about drawing, doesn't have to be anything like as complicated, right? Now, I'm just going to illustrate that by doing something like turning all that to, that can stay. I'll make those, I'll get rid of those, and I'll get rid of those. No, I don't want that. Take that out. In fact, leave and get rid of those numbers there. Okay. Okay. That's pretty much a cash flow diagram. Okay. It's just an example of things. It's a thing you can just kind of draw up on a piece of paper, back of a used envelope, whatever you want to do it. But when we're trying to work out complicated present value or future value problems, especially for this kind of capital budgeting stuff, writing out something like this is important. How does it work? It is no more than a timeline. Right? There's a timeline. Numbers, what have I done there? Numbers going from the start of the project, like 0. Cash flow is assumed to happen at the end of each time period. So here's time period 1, 2, 3, 4. Just about most of the time, for especially capital budgeting, we're looking at annual cash flows right up to the end. Typically, the part of the cash flow diagram that you're most interested in, because this is where the data is the operating cash flows. We're going to be talking about that. We already have. This is what happens year by year. It could be the dividend coming from a share. It could be the interest coming from a fixed deposit. It could be the rent coming from a property investment. Any of those. This is operations. So the 100, 100, 100 in this particular example happens to be the operating cash flows, and they tend to be up arrows, and so they represent a cash flow coming into my pocket, and I simply put them here with some vague indication of their magnitude. Okay, so they're up arrows, the rent's coming in, or the interest is coming in, or the dividend is coming in, more or less regular year by year. And then at the end of the period, and this is the sort of stuff that we're focusing on more now, at the end of the period, you either close the mine, sell the old worn out machine, sell the share, or sell the investment property. Or maybe get your money out of the fixed deposit or the debenture. Okay. And so in the last time period, here it's time period 10, you get the operating income, which in this case is 10. And you also get the sale of the project or the salvage value of the project, which is often a bigger number, right? If I'm getting $100 or $100,000 rent per year out of some property and then I decide to sell it, I'm going to see selling the property for an awful lot more than the rental value of it. It's going to be probably something like 10, 20 times as much. Right? And so that's the general layout here. These diagrams are extraordinarily useful mental aids, right? They simply help you to see what's involved in the cash flows. And if you go through a textbook, you'll find there will be places where this thing is kind of laid out for you. And I recommend that you actually do it yourself. When you've got some complicated problem, you're not quite sure whether it's present value or future value, you're not sure what to do with the cash flows. First thing to do, simply write out or draw up, using this sort of thing, a diagram, ultra simple. You don't have to use a ruler. You don't have to measure the size of the arrows, just to get a vague idea, right? This one's going to get a bit bigger. This one's a bit smaller. These ones are about the same size. That's all you're really wanting to do. Just help your brain, right? This one should be 10 times as long as that one, shouldn't it? Okay. I haven't bothered. Doesn't matter. I know that it's a bit longer. And I know that at the end here, I'm going to have the two cash flows. It's just a very practical aid when you're working with it. Okay. That's why I wanted to show you this diagram. Fabulously important for solving problems. And really, I've had an awful lot of students contact me, and you guys will know who it is. And often as part of my answer, I've said, draw yourself up a cash flow diagram. So I thought I'd start the class today by actually showing you what I mean by that, so everybody's on the same page. And again, I mean, not important, and it's not time waster. You just put on a scrap of paper, just get your head sorted, and you'll find it makes a huge amount of difference in you working out how to do the maths. This particular diagram is meant primarily to introduce people to using the built-in Excel function. So down there, it's got the built-in or some of the built-in financial functions for Excel that you can use, and they're kind of applied to that particular problem. What else is on this diagram? I'll just go and bring the rest of the numbers to light. Yeah, won't worry about that. But in fact, it's probably better if a lot of those things are left out. Here it's really displaying how the discounting factor work. The other magic number here, and you guys will be familiar with this by now, the magic number, the real key to this is the discount rate. And in this diagram, if we take this from 0 to, let's say, 10%, you see that the diagram now starts to make more sense, because you can see that here are your future cash flows. Here's your discount factor. We've done those already, haven't we? Here are your PVs. Mate, and go through any textbook, and just about all of them, the textbooks tend to use 10%, and you get to know the numbers, right? 9090. I've mentioned that one to a few times, and this sort of general pattern with 10%. But it doesn't have to be 10%, could be 15% or 20% or 5%, doesn't matter. But that's the fullness of what this diagram is showing you. You don't have to build an Excel cash flow diagram when you do this. Pencil, back of an old envelope is all you need. This one has got all this extra cleverness on it, all this stuff, simply to show you in greater detail what's happening and to introduce the Excel functions. I'm going to put this spreadsheet onto the resources we're developing week by week, and so you can have a look at it and just think about it if you like, and see if you can use it. But the really important thing is this visual aid, right? The up arrows, and here we've got the cost, the down arrows. It's just a conceptual tool. Okay, that's important. Let's put that away now. Let's come and have a look at the slides. Now, again, earlier on, I was sort of saying how, hang on, that's week 6, don't want week 6. I had week 7 out as well. There's week 7, here's week 7. Okay, lock that out. Right, and basically, week 7, we're doing more of the same stuff. We're looking at cash flows and cash flow budgeting. Okay, we're really moving this forward. Now, again, read this stuff. I can read it to you. I was actually talking to one of my former students, actually just yesterday, and he was saying how he gets his computer. Apparently, he's got some option on it. Mine's probably got the same thing. I've just never bothered to use it. But he gets his computer to talk to him, and so he'll just open up some file. He'll sit himself in the bath. He likes having baths. I like having showers. But anyway, that's all right. He sits in the bath, maybe has a beer, and gets the computer to read out all of his study notes. And I thought, fabulous way to study. You can do that too if you like. But this is not hard to follow. It's just a matter of reading through it and following what it's saying. There are a couple of things in here that I do want to focus on. One of the things that, to get your head around how finance works, especially in corporations, is to look at the way that an awful lot of this mathematics, now that we're starting to apply it really seriously, has to do with really managing, perhaps I could say engineering, your profit and loss statement. Finance is just all about the manipulation, the conscious management of your two accounting reports, your balance sheet and your profit and loss statement. I think the emphasis is probably in practice on the profit and loss statement, and so that's what we're going to be looking at particularly today. But your balance sheet is in there, really important as well, especially when we're talking about things like leverage. You know, when the company is thinking about shares or debentures or borrowing from the bank for whatever. Okay, here with the capital budgeting decisions, it has a lot more to do with the profit and loss statement. And so if you remember that from when you studied accounting, really important for you to get really on the ball with that. And I remember when I was first studying finance, I just realized that really understanding that the profit and loss statement is something that you find as a result of, you know, just where all of your accounting, bookkeeping stuff kind of distills into. It's actually something that you manage and you look at very consciously to look at how you get the best performance out of it. And that's a good way of understanding a mighty big part of business finance, managerial finance. It's the management, it's the conscious directing of your profit and loss statement so you get the best result for, you know, all concerned, well, the shareholders. Okay. And so I thought, well, hang on, we better focus on this a bit. You find that you go through the textbook. Now, you guys may have gone through the textbook very systematically, and I hope that you have. And so what I'm about to say may not come as a huge surprise. But I find that as we're reading through the PowerPoints especially, a lot is taken for granted because we don't define our terms very well. This diagram over here in the edge is actually really a theoretical presentation of a profit and loss statement. It's the character, if you like, of the profit and loss statement. What they're saying in the notes in the PowerPoint is that when we're looking at the impact of some particular activity, some project within the company, you know, I might be BHP and I'm thinking about starting a new mine or building a railway or a warehouse or buying a photocopier machine. Each one of those is a project. What I'm interested in is what contribution that project is going to make to my overall cash flow, my overall profit and loss statement. So I'm focusing on my incremental impact on the profit and loss statement, how that works through. You can read through those notes, I think, at least as well, if not better than I can. But in order for those notes to make sense, I want us to look at what the profit and loss statement is. Now, this comes from, oh dear, I found it in the textbook. I can't tell you what page it's on. You guys might be able to find it. Not really important. The fact is, it's here, and I can put this up as a file in Moodle as well for you if it'll be useful to you. I find this a really useful thing to do to start with because it gives you the definitions of what these different parts of the profit and loss statement are really telling us, and that gives us, if you like, the foundation for eventually using these parts in designing and budgeting and planning strategizing. How are we going to get the best financial performance out of the company? Okay, enough said. Here are the parts of the profit and loss statement, roughly. And here is their significance, their financial significance. Let me work through them. Profit and loss statement starts off with your revenue minus your operating expenses, your variable expenses. So that's something like as simple as in a shop. It could be the revenue. I might be selling, I'm a petrol station. Imagine that, right? Most of my sales are all in petrol, fuel. My revenue comes from what I take from the pumps. Like people put the petrol in their car, they come and give me money. That's fantastic. I like people giving me money, and I call that revenue. However, I have to fill up my petrol tanks down underneath the tarmac from time to time. So they're operating expenses by having those big tankers to come in and fill the station with petrol and diesel and stuff every now and then. So my basic business is operating by taking revenue, cash coming in, and paying my operating expenses, which is the cash going out. And a fair bit of my operating expenses tends to be in proportion to my sales. Okay, the more petrol I sell, the more often the tanker will have to come in and fill up the big tanks that are hiding underneath where the cars drive. Revenue minus operating expenses. And getting some of these terms is important. In the olden days, that would be referred to, or the subtraction there, that's the actual profit I make, isn't it? You know, I sell my petrol for $1, I don't know what it is this week, let's say $1.20. I sell it for $1.20. I might buy it for $1. Now, anyone who's been at all close to the oil industry knows that those petrol station operators, if they're selling it for $1.20, they're probably buying it for $1.15 or something. They don't make a great deal of money on it. In fact, it's probably more like $1.80. Anyway, the important thing is revenue versus operating expenses gives you what's called the gross profit. It used to be called the gross profit. These days we use a far more techo acronym, EBITDA. When I was doing finance, it was simply EBIT, and then sort of DA got added onto it. Knowing what all that stands for is really handy because that gives you an idea of its anatomy. It's earnings before interest and taxes, depreciation and amortization. And so what have we got there? Gross profit, which is earnings before interest and taxes, and depreciation. That's the first part. It's earnings. Okay, it's your gross earnings. It's the simplest form of income. And it takes out your operating expenses. Operating expenses. Oh, I should have actually been just breaking this one up between fixed and variable. I was talking about variable expenses. This operating expenses includes other things like if I've got my service station, I'm getting the petrol delivered from a wholesaler. But I'm also doing things like paying wages because I'm going to have an attendant there whether they're selling any petrol or not. I'm going to have the lights on. I'm going to have the refrigerators going. I'm going to have the telephone connected. I'm going to be paying rent on the property. I'm going to do a whole lot of things that are actually expenses. They're operating expenses, but they're operating expenses regardless of whether I'm selling petrol or not. Okay. So you take out all those operating expenses, fixed and variable, and that gives you the gross profit, the EBITDA. Why is interest, taxes, depreciation and amortization separated out? Because these critters, the ITDA, are things that you can decide to change. You can decide how much money you borrow, and that's going to have a big effect on how much interest you pay. To a certain extent, tax is manageable. That's a bit of a delicate topic. I won't talk about it very much now, but basically depending on your own personal situation, how much tax you're charged and a few other things. So that one is something you get to manage. Depreciation. Now, when you're doing accounting, you've been told that, well, you buy stuff that wears out year by year. you work out the depreciation, so you've got a fairly close to market value sitting on your books. That actually turns out to be something you can manage as well. For instance, if I rented my photocopier rather than buying it, I wouldn't have any depreciation because I wouldn't own the thing for it to depreciate, but I would have the leasing costs. And there's an argument as to whether leasing costs should be in operating expenses where they traditionally went, or should they be one of these things that comes down out of the EBITDA. Last thing is amortization, which also is a finance expense. It is the retiring of your capital assets. Okay, that's the first part. The EBITDA is an important kind of benchmark because, to a certain extent, what's above the benchmark is the real business. What's below the benchmark is something that you get control in terms of the way that you structure your financial management. Then we've got the depreciation and amortization. As I say, if you rented your photocopier rather than buying it, you simply wouldn't have any depreciation, but you would have a lease fee. And the lease fee would be sitting up here, whereas the depreciation's down there. And you say, well, it's there, isn't it? You know, and I'm saying, well, there's actually more to it when we analyse the decision, whether we're going to have depreciation by owning the asset, or do we have an operating cost when we lease it? And that's an interesting puzzle. You actually use the same mathematics that we've been using here, up arrows and the down arrows and the present value stuff and all the rest of it. And so you can apply it to that question. Okay, let's move on. At this point, we've really got taxable income. That's the accounting way of conceptualizing this. Well, it's the pre-interest in operating income. Now, actually, this one is curious because we should have interest in here as well. I think the 1 minus T, whatever it is, TC, T, whatever, takes account for that. Net operating tax, net operating profit after tax, depreciation, amortization, and so on, down it flows. This top part was what I want you to look at. And really what I'm describing to you is the way that these things are manageable. When an accountant prepares this, they prepare it on the basis of accruals, prepayments, and so on. So they get a very precise idea of what notionally over the long term is your profit. In finance, we're not so interested in profit. We're looking primarily at cash flows. As we go through what we're going to be talking about today, or you guys are going to be reading through the PowerPoint slides or reading through the textbook, hopefully taking this perspective. And remember, the important thing with this is that we're aiming to manage the profit and loss statement, not simply accept it as something which just simply comes out of, this machine called the factory or called the business, right? It's something that you get to manage. Right, let's put that aside now. And I want to go back to our slides and just kind of run through those, and then we'll take a break. Okay, so as you read through those, having this at the back of your mind, as a finance manager, you're going to be managing the profit and loss statement consciously and for optimum results. Okay, most of the rest of the stuff will make sense. And as I say, you guys can just read through it. And this is really the textbook kind of boiled down to bullet points. Okay, read through those, a couple of examples. We won't worry about the examples. Now, I would like you to look at this slide and take care to maybe memorize it, because these rules are very important. Okay, we're looking at cash flow, so we're not looking at accruals and prepayments. You guys have done accounting recently, so I assume that you know what those words mean. When we're doing this from the point of view of a business which is considering some project, then we're only going to be including the impact of the project on cash flows. And so we're assuming that there are other cash flows going on. For instance, in real estate, if I'm sitting here as a university academic, I'm getting my salary. However, to prepare myself for a nice retirement, I might own an investment property or 2 or 3. Now, when I analyse my investment properties, actually I had one of my former students ask me to do that. They had 3 investment properties, and I was kind of pretty impressed that a university student had 3 investment properties, but that's just their situation, which I thought was fabulous. But they were asking me the question, I think they're not really performing very well, and I'm thinking of getting rid of one. How do I do it? I should have simply said, go back to business finance and apply what happens in week 7, right? Here, what we're actually looking at, my student is saying, I've got these 3 investment properties and I've got a job. What I want to do is analyse each one of these 3 investment properties to consider the impact of the property's cash flows on my students' total cash flow situation. Every year they're paying a certain amount of rent, they're paying interest to the government, to the bank, paying taxes to the government, and they're getting salary and all these different sort of things, incomes, revenues and expenses and stuff. And what I said was, look at those 3 properties. And we looked at it from, put our real estate hats on, and then we also looked at them from a finance point of view. So we just looked at their cash flows. And then from that, we're able to nut together a strategy for which one was a good idea to sell at a particular time. Yeah. Okay. Include the impact of the project cash flows on from other project lines. Now, this is because sometimes you run a project, let's say an investment, specifically to lose money. And the reason that you get to lose money is that because amongst your whole complexity of cash flows, it's an advantage to manage when you take your cash flows. For instance, a lot of people buy real estate in a situation known as negative gearing. What that means is that they've got a big salary and they don't want to pay tax today. So what they do is they get a dog of a property, which they borrow to the hilt, and are actually losing money on the property because they have to pay the bank back a whole lot of money, like in interest payments. However, they're confident that over the next 10, 20 years, that property, as much as it's losing money month by month by month, is actually going to grow in value so much that when they retire, different tax environment, they're going to be able to make a huge profit. Right? So negative gearing is a very popular form of investment amongst Australians. Okay, and the reason is that the negative net rent after you pay interest, the impact of that project, that negative cash flows month by month, and then the final capital sale, the capital gain that comes from the sale of the investment property in 20 or 30 years' time, is that the person running that game is actually financially a long way in front. So you consider the impact of the project on the cash flows, because what you're doing is reducing the investors' taxable income today, so they're able to earn a greater amount of cash in the future, and overall are a lot better off than simply paying the tax today and not having the superannuation sort of covered very well. Okay. Include all opportunity costs. Opportunity costs is the evaluation of what you miss out on by making a particular decision. If I've got a vacant block of land in the city and I decide to turn it into a hotel versus an office block or a shopping centre or something, the opportunity cost is the shopping centre I don't have or the office block I don't have because I've got a lovely hotel. This is a tricky one. Forget sunk costs. And what that means is that if I'm looking today at some situation where, I don't know, let's say my grandfather had some classic motor car, I don't know, a V8 Ford, something or other, really lovely car, and he loved it dearly, da-di-da-da, and unfortunately it's been sort of, sat under a tree for the last 20 years. And even though potentially it could be a fantastic thing to restore and get going again and, burble down the street with and all the rest of it, the fact is it's going to cost me $100,000 to, rebuild it back to its former glory. Doesn't really matter what's been spent on it in the past. That's the sunk costs. The fact is that from today, I'm going to have to spend $100,000 to get this thing on the road. And in terms of its financial value, apart from the sentimental value because it came from my grandfather, the financial value is what I could sell it for if it was restored, less the cost of restoring it. And if I'm only able to get $80,000 for it as a restored classic V8 Ford, but it's going to cost me 100 grand to put the thing together. It's a stupid thing to do, even though $150,000 might have been spent on it over the years, or who cares, think of a number, right? You forget the sunk costs. You only look at the here and now, looking at cash flows moving forward. Those cash flows might involve, or will involve, the sale of the thing. So the classic V8 Falcon, an important part of these future cash flows is the potential sale, okay? But you don't worry about the past. Last rule, include only after-tax cash flows in the cash flow calculation. And the reason for that is that tax is a curious thing to manage. Now, there's a really important concept or distinction that you need to make. There's a difference between tax minimization and tax avoidance. Tax minimization is when you use your understanding of the taxation system and all of the provisions in the Tax Act and the other things to do with tax. You use those to consciously structure your business or your project or whatever it is, your financial affairs, consciously structure your financial affairs so that you don't pay tax unnecessarily. For instance, I'm working from my study. I'm not at campus at the moment, and you're probably aware of that. Most lecturers during the COVID craziness don't work from campus. In fact, campuses in some cases are closed. Now, I can sort of simply do this as a benevolent activity and use my computer and the electricity around the house and all the rest of it. And, you know, I'm here anyway, da-da-da, right? Is that optimum for me from a taxation point of view? I might be losing the opportunity to do tax deductions. It's manageable. So to minimize my tax, in other words, pay the correct tax, the legal proper amount of tax for my situation, is a prudent, smart thing. If I don't make some deduction or claim for a deduction when I do my tax return, then maybe I'm supporting the government a little bit better. Maybe I'm doing sort of some nice social justice thing by letting more people being on the dole, I don't know, but I'm paying more tax than I need to, which is just a little tiny bit stupid. Okay, that's tax minimization. That's opposed to tax avoidance. Tax avoidance is when I sit in my study and maybe do some consulting work, and I sort of take cash for it, and I don't pay GST, and I don't pay income tax. I do a lot of other underhanded, dastardly, illegal, and immoral things, and I avoid the tax that I'm legally obligated to. That is a very unethical thing, and it hurts. Well, it makes me money, but it hurts the community. Okay, two completely different concepts. One's tax minimization, which you should be doing, and learning finance is a very good way of coming up to speed with many aspects of it, versus tax avoidance, which is doing an illegal and an immoral thing, which is not paying the tax that you should be paying. All right? And a lot of people get sort of muddled up about that, because I think tax minimization is immoral because it's sort of avoiding tax, or other people justify tax avoidance and say, well, I'm only minimizing, I'm only managing it, you know, well, in fact, you know, why is it you don't sort of, you know, write out receipts, and why you only trade in gold or something? I don't know. But rule 5, include after-tax cash flows in the cash flow calculations, right? And you'll find there's examples here as we go through. And we got some practical considerations. Again, read them. It's important to be able to distinguish between nominal dollars and how dollars change over time. So it's sort of practical notions about estimating cash flows. Tax and depreciation is extraordinarily important and really a study, a complete unit in itself, but read through the notes here. I'll let you read through those because it's pretty much comes from that diagram that I showed you first up. And again, read through that one, and that will take us, still got a bit more to do. Okay. We'll take a break here, I think, because we're running a bit behind. I'll take a break. I'll stop the sharing. We'll go on to this after the break. I'm going to turn off the recording. Okay, ladies and gentlemen, we're back in business. And I do have the recording started again, so don't need you to come in and remind me. Okay, let's carry on. What this week is telling us. I think we finished this before the break by getting down to the estimation of practical cash flows, future cash flows. And let me just go back to this previous slide here. Expected free cash flows. Free cash flows is what the slides have been kind of bringing us up to so far. The expected is important because what we're doing here, we're putting in the notion of uncertainty. We expect it, we're not totally sure of it. And here, all we're doing in the next few slides is looking at weighted means. And what that means is that we're saying we expect one of a number of outcomes. We're going to be doing something into the future. The future is uncertain. It might go really well, might go really badly, or it might go according to plan. If it goes according to plan, we might say we've got a 50% chance of that. We might say there's a 25% chance of it being super, super successful. Fantastic. And there's also a 25% chance that the thing will be a dog. It won't work very well at all. In which case, our revenues and expenses and so on, our EBITDA, will either be glamorous, ordinary, or lousy. Okay, and we simply do weighted mean. Now, I've done the weighted means before when we were looking at risk and uncertainty in patterns of cash flows in general. Here we're doing exactly the same math, so I won't even bother putting it up as an example because we've already done this stuff. And you'll see down here the maths for it is kind of laid out. Work through that yourself, and it's probably a good idea for you in your own time. Remember, you've got 2 hours of class, you've got 10 hours of learning to do. So this is where you kind of work through this stuff and you actually sort of put it on a piece of paper. Work it out on a piece of paper yourself. A lot easier to make it become very much second nature in your mind. And see what they're actually saying here. Simply a weighted mean. And so we're going to write it in more formal terms like that. We're going to discount them. Again, write out that cash flow diagram, the timeline. If you find this a little bit tricky to follow, because on the back of an envelope, that diagram will actually help your brain kind of put it all together properly. Okay. And another example, and on you go. It's up to you whether you want to do both examples. I recommend you do at least one. If it's really, really making sense to you and you think it's ultra boring, then move on to do something more interesting. If you're still a little bit rattly with it, when you do the first example, do the second example. Okay, look at projects. When we're working this out, remember last week we got to net present values and so on. It's as though sort of net present value, I said a lot of good things about net present values, and I said a lot of bad things about internal rate of return and all the rest of it. So I probably am a bit of a fan of net present values myself. And I think that's because that's pretty much the reality of the situation. Net present value is a very useful decision tool. It has lots of applications, lots of things. But I didn't get to talk about the downside, the dark side of net present value. Net present value is a number, a equivalent present value in dollars number. Okay. If I'm comparing two projects, one's got net PV of, I don't know, $1 million, the other one's got a net present value of $2 million. Going by what we were talking about in previous weeks, they'll give you the impression that you'll definitely go off and get the $2 million NPV project. Okay. Pretty obvious. You go for the maximum NPV. And you don't touch anything which has got a negative NPV. That's the rule we learned, I think, last week. Not quite so easy as that when we're comparing projects. And the reason is that if I had to tie my money up for 6 months to get a net present value of $1 million, and perhaps if I didn't even tie very much money up to get an NPV of $1 million in 6 months, that's going to be an awful lot better to me than if I have to tie up let's say, 10 times the amount of money for 5 times the amount of time to get the same, or to get the 2 million. Okay, so on one hand, you're saying, oh, if I look simply in terms of net present value, 2 million is better than 1 million, choose the $2 million project. But if I look a bit closer and I say, oh, you know, the $1 million NPV project only takes 6 months to run, and I get $1 million in 6 months, that's a lot better than having a 10-year project that ties my money up for 10 full years to get me the $2 million. So I might have projects with different lives. And you'll see an outline of that in this slide and in the ones that are following. Now, there are a couple of approaches. I'll let you read through these. Good idea to have a theoretical understanding, what have you. The most important thing, by the way, is to start off by a conceptual understanding. A conceptual understanding is that net present value does not comment, does not give you information on two things: the scale of the project and the length in time of the project. It's simply a dollar value. And it's one of the places where IRR has a certain conceptual advantage, because being a ratio, a rate of return, the IRR kind of has embedded with it a appreciation, at least, an inclusion of consideration of the amount of dollars that it takes to turn out a certain amount of financial benefit. Whereas that connection between the financial benefit in NPV versus the occupation of funds and resources actually disappears out of NPV. I'll let you give some thought to that, maybe look at some of the examples we've done to sort of check if what I'm saying is true. It's the best way to actually see it yourself. But if Small says that net present value is a better way of comparing and evaluating capital budgeting decisions versus the reality that NPV in itself doesn't take into account the scale of the project and the duration of the project, oh, got a bit of cognitive dissonance here. You know, like, it looks a bit crazy. How do we overcome it? Well, we overcome it by a couple of things. The seat of the pants approach to overcoming it is to use NPV to only compare projects which are of similar duration, and or only compare projects which are of similar cost. If I'm looking at something that's going to cost me $900,000, something else is going to cost me $1 million, something that's going to cost me $1.1 million, not a huge amount of money in terms of, a huge amount of difference in terms of the amount of money it's tied up. However, and so if I deal with my NPVs on the basis I'm thinking of buying an investment property, and here's one for 875, here's one for 900,000, here's one for 910, here's one for 900 or 890. Yeah, okay, it's all about the same amount of money, so the magnitude problem isn't a huge issue. The duration problem, likewise, solves the problem if we do everything over a 10-year time frame. And it's actually, if you get into the mathematics of this stuff, it's sobering at the very least. Edifying might be a nicer term for it. But one way or another, you really wake up to yourself when you see the effect of time for end present value. To the extent that when I apply this stuff to real estate, for instance, one of the things that I like people to dwell on is the fact that if you do your discounted cash flow analysis over, let's say, a period of 10 years versus a period of 5 years or 20 years, you can end up with completely different results for the same project. That's weird. But it is the way that things work. Okay. So you've got these two issues, scale and duration. Now, how do we get around that? Well, what we do is we use the NPV as the first level of analysis, but then we also then consider ways of including consideration for scale and duration. In the duration area, what we can do is a couple of different, you call them tricks perhaps. of ways of turning the NPV from a particular limited duration, which may or may not be comparable to something that we are testing it against. And one way or another, we've got to sort of unify the duration. A couple of really nice ways of doing it. One is a thing called effective annual NPV. Effective annual NPV. You work out the NPV. Let's say it's on a 5-year project. You say, okay, I'll get my $1 million in 5 years. Well, good. That works out to about $200,000 a year, contributing to the NPV. If I got the $2 million NPV project, right, and it takes me 15 years or 20 years, okay? I've got the $1 million project and it takes me, what did we say, 5 years? We got the $2 million project and it takes me 20 years, right? What's the annual contribution? What's the annual equivalent net present value? So I divide the $2 million by the 20 million, right, sorry, the $2 million by the 20 years, and I end up with $100,000 a year being contributed in a way to the net present value. Not totally rigorous mathematically, and maybe not a fabulously independently meaningful number, but annual equivalent NPV is an excellent way of comparing projects of different duration. And there are a couple of others as well. One is to consider multiple operations of the project. Okay, remember in our example, if we've got one which takes 5 years and it has an NPV of $1 million. Well, at the end of that project, end of that 5 years, I might sell it off. I might do another project. Right? Another 5 years, I'll get another $1 million, won't I? If I do the same thing. Right? What I can do is say, well, if I've got a 20-year project, which gives me an NPV of 2 million, during that time, I can run the other project 4 times. And so each time I run it, I'll be getting my $1 million worth of NPV. By the time I get up to 20 years, I've run that $1 million project 4 times. So the NPV in total over that time is actually 4 million. And so it looks like the $1 million NPV project is something like twice as efficient from a financial point of view as the $2 million project, even though the NPV appears to be pointing us in the other direction. Okay, so this is a multiple, application kind of approach, and it's sort of handy if you can do that in a simple way. If one of the durations is a multiple of the other, very easy to do. If you've got one project which is 7 years and the other project which is 5 years, you can say, oh, well, 5 and 7, not much different. Well, in fact, it's almost 50% different or 40% different. What you might have to do is say, well, I'll run the 5-year project 7 times. I'll run the 7-year project 5 times. So over a period of 35 years, I've got the same duration. So I kind of mathematically equate the durations by simply running the projects multiple times. I think that should make sense conceptually. And then you are able to also, you basically equated the durations. NPV perpetuity approach is a slight variation on the two that I've described. Basically, all of these approaches are basically ways of simply equating one way or another the durations, usually by relatively simple approximations. Some people might complain that maybe the project, the 5-year project, isn't of the sort of thing that can be done 4 times in a row. That's a practical consideration. But as a theoretical approach, it is a really nice way of overcoming the duration issue. Okay, let's move on. Different lives, I'd like you to read through that, go through the maths. Okay, I've also, before we leave there, I've talked about the different costs, different values. When we looked at the duration and working out an annual equivalent NPV, you can do a similar kind of thing for different costs. How do you relate the NPV to the scale of the project? And the way you do that is simply by taking your NPV, the $1 million, and you divide it by the capital cost of the project. And so the $1 million, if I only have to sink, let's say, 5 million into it, then, you know, I get $1 million worth of NPV for $5 million of my cash kind of being locked up in the project, okay? And I might want to compare that to the $2 million project. $2 million project might cost me $10 million to get running, okay? If I divide the million of the first project by the cost of the first project, it gives me 1 divided by 5, or about a ratio of 20%. Is that right? 1 million divided by 5. If the $2 million project takes me 10 years, I can do the same division, 2 divided by 10. That's also 20%. Right? But what I've done there, you see, is equate the magnitude, the scale of the project. That ratio, NPV divided by the capital cost, is referred to in some texts, in some circles, as the Profitability Index. Profitability Index. And so you get the Profitability Index, very simple thing to work out. Compared to all the other maths you've got to do to go and work these things out, Profitability Index and annual equivalent NPVs are extraordinarily, you know, simple. They're usually just divisions. Profitability Index is the NPV divided by the capital cost. In some places, you'll find the textbooks will talk about the importance of taking into account the total capital cost, because for a lot of projects, a lot of investments, it actually, you pay for it over the first few years of the project. For instance, if you're getting a business started, you might put a certain amount of capital into getting the business started with the hard things like, you know, machines, computers, vehicles, salaries, whatnot. But it might take you a year or two to get your customers worked out. And so you buy all the stuff to get your factory going day one, and then in 12 months' time, you're still losing money, so it's actually costing you more while you build up your marketing presence and all that sort of carry on. And so it's only in the second year or third year or what have you that the thing is actually coming out of the red. And so your capital cost might be protracted, so you may have to include more than 1 year's cash flows to do that. Won't worry about that too much, but I'll just kind of put it in so that you know all of the ins and outs there. But Profitability Index, very, very easy to calculate, and it does equate the magnitude of projects when you're using DCF, net present value as the evaluator. IRR, it doesn't have to be adjusted because the IRR is already a rate and it already is scaled, if you like, to the magnitude of the operation. So a 12% IRR is going to be better than 11% IRR, irrespective of how long the project is and how big the project is. Okay, let's move on. Read through last issue. When we're talking about harvesting an asset, what we're really saying there is that over a period of time, often assets either don't appreciate as fast as you would like, or they actually lose money. If I got a big business, I might be BHP Australia, and I might put in a whole lot of mining infrastructure, say conveyor belts or what have you, it will come to a point where keeping that particular infrastructure in place becomes more expensive than replacing it. You know, an old conveyor system, you might end up with having your fitters and turners running around kind of fixing the stuff up and tying it together with fencing wire or something to try and make it keep going. And your maintenance costs might get to the point where they're really eating into the contribution of that whole thing to making a quid. And so you have to know when to let go of things, when to scrap them if they're physical machinery, to a certain extent when you sell the investments if they're you know, appreciating assets. Like with real estate, for instance, there might be situations where you might have an office building as an investment. As you go through time, yeah, sure enough, the real estate market is moving ahead, but your building might be getting very tired, and you're going to get to the point where you have to decide whether you spend an awful lot of money on renovating the thing, or do you simply sell it off to somebody else who is more comfortable with renting an older building. And so again, it's a question of knowing where to get out of a particular project. Okay, I'll let you read through those slides, which is very much common sense stuff. Now we're going to move on to the question of capital rationing. I want to move through, read through these. I've already introduced this idea of variable costs and fixed costs. You may have done a bit of this when you were looking at accounting, and you'll remember that I mentioned that when we were looking at this diagram, where we were going through this very top part of the profit loss statement, where I was talking about operating expenses. These operating expenses split between fixed and variable. As I said, I gave the example of the petrol station, okay, where you can divide your expenses. Now, what we're doing in these slides is basically taking that a bit further and getting you to think about this. Now, the curious thing is, you say, well, what's the point? Why bother? You know, you've got to pay salaries, for instance, and you're going to have to pay that regardless. So why bother sort of saying that salaries or the electricity for your service station is fixed, whereas the cost of the petrol that you're selling is something that's going to vary? Well, the reason is that very often you're able to manage these things. For instance, if you buy the pumps or some other part of the petrol station rather than leasing them, you're going from a fixed cost, which is the lease fees, to a variable cost, which is the maintenance, depreciation, and so on of the physical assets. And you've got to juggle, weigh up which one is preferable. In the textbook especially, there's kind of more details on how you do that. The concept really is to say we recognize that fixed costs and variable costs can be managed. I might rent my cars rather than own them. And if I rent them, it means if they break down, I simply take them back to the person who I rent them from and say, your car's broken, please give me another one. And that's what they'll do. If I own it and the car breaks down, I've got to take it along to a mechanic and spend a lot of money. So in one case, I've got a completely different pattern of costs compared to the other. Okay, and that's manageable. Right, and when we get down, I want to get down to it, here we go, some diagrams. These diagrams are kind of worth thinking about. The point is that because we can manage our fixed and variable costs, if you have high costs and low variable costs, it means you have to have a certain amount of revenue coming in to simply clear the hurdle of paying for your fixed costs before you start to actually make a profit. Whereas if you find some other approach where you're able to turn everything into a variable cost, then it means that you're making money right from the start. It's just that your rate of making money is going to be lower. And there's a worked example that kind of go through here. An example, actually using manual rather than automated production. If I've got a factory full of men working on traditional machinery and so on, sort of making something, maybe using lathes or welders or whatever they are, I don't have much by way of variable cost because the technology is not costing me a lot of money, but I am paying a fair bit in wages. And the more work that I get people to do, then the more wages I'm going to be paying. So I'll consider that to be a variable cost, assuming that we're paying wages, you know, on a sort of casual rate or something. Okay. On the other hand, if I've got an automated machine, I might be spending maybe 10 times as much in terms of fixed costs. But for every unit of sales I make, it's actually not costing me in terms of wages, and so I make a lot more profit. So in a sense, I've got to pay for the cost of putting in the automated machinery, which can be quite considerable. But on the other hand, once I flick the button and actually switch on the automated machinery, I don't have to pay wages. And so my variable costs sort of change. That's what this diagram is meant to describe. And what it's really saying is I've got I've got more by way of fixed costs that I'm paying for with my automated production, because I've basically got sort of complicated machines and so on that I've had to put in. But each one of those complicated machines, expensive machines, its gradient, its rate of turning a profit in terms of the number of sales I'm making is actually higher. So as I go further up here, my profit is far greater using automated machines than using manual machines. But I have to be operating in this kind of realm for that difference to suit me. I'll let you go through the maths on this. When I first studied this fixed cost, variable cost stuff in this sort of detail, I was absolutely fascinated by it, because it often gets you to think about, the way that your decision is going to be different depending on how confident you are of the scale of your operations. For instance, if you're operating in the scale of, in this example, the number of units sold, operating, let's say, between 15 and 20,000, then you'd be a fool not to do your hardest to go and automate your machinery. However, if you're down here, maybe living in some regional town or what have you, there's not a lot of demand for what you're doing, what have you, and you sit a lot of time just waiting for work to come in, then it's actually better for you to do things manually, so your fixed costs are quite low, but your gradient in terms of the amount of profit you make for every additional unit of production becomes a lot more sober. Okay, so here the manual production is actually more profitable. Here the automatic production is more attractive. Okay, and it's kind of interesting because we see what we've really got here is a situation where we can say, yeah, well, in fact, whether we automate or whether we use a manual approach is really dependent on the volume of our sales. Now, this is kind of interesting in the beer brewing area. The development of lots of little boutique breweries. If I'm, Carlton United Breweries or something, some mega brewer, then I'm going to have to be operating at this mammoth scale because I'm employing very expensive machinery and large scale, clever production technology. And so I've got an automated production system, and I am operating at a very high level of output, and to a certain extent, a level of output that is not too risky. Automating up here is very wise. However, if I'm some little boutique brewer brewing beer, in the back of a, normal size shop, in the front of the shop is a bar, and that might be nice as a pleasant place to go and have a drink. But because my scale here is so much smaller, it may actually be worth my while to brew my beer in the traditional way. It takes a lot of labor, doesn't take more than a few buckets and casks and things, so very little capital cost, and I'm actually more profitable for operating down here. Read through this and just think about it until it sort of makes sense to you. It's a delightful relationship, so I do recommend that it's worth spending time on. Okay, I'll let you read through that. And that one too, I think, is fair. It kind of follows on from what we're looking at earlier on. Okay, risk analysis. I'll let you read through the operating leverage. It's not, well, it's quite a straightforward calculation. It is a useful thing to do. Basically, it is a ratio which is developed to indicate how efficient, if you like, revenue is being turned into EBITDA. I'll let you read through the text on that. Where's my slide? Okay, the operating cash flows, again, read through. Break-even analysis. This is a very nice practical ratio. Break-even analysis basically is working out that level of production that enables you to end up neutral, just paying your bills without necessarily making any fancy profit. I won't go too much into the theory and implications and criticisms of it, but simply I'd like you to read through this and look at how the break-even calculation is worked out. And you're most welcome to post comments, perhaps up on the general discussion bulletin board for the unit on this. I would really appreciate it if you did that. Okay, break-even analysis. It's interesting. It's fairly straightforward. Useful to be able to do if you need to, but not particularly anything to lose sleep over. Okay, let's look at risk analysis. Now, this is getting into an area which will become very important, especially for those of you who end up doing anything in the area of property investment or property studies. So financial advisors amongst us, or possibly property students themselves, will find some of the things that are mentioned here very, very useful. Okay, risk analysis. We've got the situation where we're asked to do all of these estimates, and often people get carried away thinking their estimates are in fact, definitive statements of the future, and they're not. And even though we might have the best intentions of getting the best estimate that we can, there's still going to be uncertainties with them. The COVID environment that we've got at present couldn't have been forecast, apart from Bill Gates, before Christmas. Okay, yet it's a really dominant kind of effect. It's going to affect all of our cash flows and all of our businesses. Perhaps some of you guys might have been affected by it because it's put a lot of people out of work, and even more regrettably, it's put more than a few people out of windows because with the coronavirus, people have been suiciding, which is particularly unfortunate. Okay, the future is not certain, I guess is really what I'm saying. How do we take into account the uncertainty? Now, going back a few slides, we had the board game example, and we're saying that we're going to working out the expected value by working out the probabilities and so on, weighted mean. That's one way. When we've got a complex mathematical system like a discounted cash flow system, there are other ways of working out, not to say that the computer enables us to, stand on our head in deep water. It's simply that the computer becomes a tool which enables us to evaluate things very, very rapidly. And that rapid calculation enables us to do a lot more analysis before we jump in and invest our money. There are a number of well-known ways of evaluating this risk. And basically it comes down to investigating what happens if your estimate of what's likely to happen in the future is wrong. So if I assume that I'm going to be selling so many widgets, but I actually sell twice as many widgets, it means that selling widgets was a risky thing to do. There might be other situations where you have dealings with companies or what have you, and those dealings are not as you would like them to be. And so even though you might estimate, you might say, oh, well, my insurance fee over the next 10 years, because I'm analysing some project or a property investment or something that involves insurance, I simply don't know what's going to be happening in the future. I'll go through the common, hang on, that's not supposed to happen. I'll go through the common approaches to dealing with uncertainty in the values, because I don't know what they are. Most common one, certainly the term that often gets used, is sensitivity analysis. Sensitivity analysis is using your mathematical model to investigate what happens if one of your variables isn't what you assume it's going to be. And so you work out how sensitive your answer is to the reality that some variable isn't what it's supposed to be. For instance, I might own an investment property, and I think the rent's going to be, I don't know, $500 a week. I buy the unit, and I do all my numbers, assuming there's going to be $500 a week coming in from the unit. But it turns out that there's some sort of a depression, there's a lot more unemployment or something, and as a result, the rent is a lot lower. Okay. I might ask the question, how much difference does that make? That's doing sensitivity analysis. Commonly, when people do sensitivity analysis, they do it by taking their most likely guess, estimate, forecast, and then they also evaluate their model if the number actually turns out higher than that, and then a third case when it is lower than that. And so there's a package. The estimate, the most likely estimate, then you're going to have the most likely upside from that original estimate. So that one's estimated. And then there's also from the middle, the likelihood of what the value is if everything kind of goes against them. Okay. Sensitivity analysis, often people think of the words as optimistic, pessimistic, and most likely. We don't have to go too far into doing sensitivity analysis in this course. We'll be doing it later on, or those of you who hang about to do property investment, you'll find that we'll be talking a lot about sensitivity analysis. It's basically checking what the importance is of errors in the forecasting of each variable. Okay. Sensitivity analysis tends to work on a one-by-one approach. And again, using the example of the property investment, I might investigate the property's sensitivity to the amount of rent. But I could also work out the sensitivity, all else being equal, assuming you get the rent you want, more rest of it. But I might want to work out the impact of maybe rising insurance prices. You know that insurance is one of the outgoings, the costs that a lot of landlords own. And so a landlord might say, well, I'm going to do is roll up all of those into one group, and I'm going to look at what the effect is of insurance on my answer. Then I might go and look at what the effect of the rent coming in, the council rates going out, a change in taxation policy, or the depreciation allowance, who knows what. Sensitive analysis simply looks at each one of those variables, they each them separately, one at a time. Some theorists have become concerned with the sensitivity analysis because it does only take one variable at a time. And they say, well, actually, that's not very reasonable, because you might have something like the interest rate changing, but you also might have the leverage amount changing. So by the time you're borrowing more, so changing your leverage, and also the interest rates are changing, the interest rates are going up and the leverage is going down, the result is going to be all over the place, right? And so people that make that observation say, well, sensitivity analysis isn't actually a very good way of analysing these things. We need something more. We need something that looks at the profitability of this investment project. And we want to look at the whole circumstances of the different likely scenarios, the different possible futures that could happen, rather than simply look at one variable at a time, because if the variables move in harmony with each other, or they maybe move in opposition to each other, sensitivity analysis kind of isolates too much. Scenario analysis is where you say, well, I've just sat down and I've done all my estimates, I've got all my values, and I've got what I'll call the most likely future. Then someone comes along, someone with a long face, and says, oh, that's all right, but what happens if everything goes belly up? What happens if the environmentalists take over and the international banks sort of stop supporting us with their loans, and basically you end up with a whole lot of question marks, what have you. As a result of that, and the fact that the variables tend to move as a herd, right? They tend to move. For instance, if you're going to have like a bad economic period, your rents aren't going to go up, they're probably going to go down. Your tenants aren't going to be quite as boisterous in moving around to getting the best deal because they're very happy with what they are. They might be unemployed anyway. A lot of your outgoings, likewise, you don't have as much control over as you thought you did. And so one way or another, this easy thing, that's the question of the trailer, becomes a very complicated thing because you're only taking the things out of context, if you like. Scenario analysis is building an entire scenario. So a COVID scenario, a healthy economy scenario, a weak economy scenario, a business as usual, optimistic, most likely scenario, and so on. And for each one of those scenarios, you do all of the mathematics and all of the analysis. And so you're looking at probably a smaller number of graphs and output, but you are able to say, in an optimistic scenario, the interest rates are low, the people aren't being locked up and sort of put away like prisoners because they might have a cold, all that stuff. The scenario analysis is able to capture the whole thing. Excel has a scenario tool in it. It's a bit complicated to use, so I'm not going to attempt to use it. Some people might want to learn how to use it and use it in some of their assessment work. That's up to you totally. Yeah, I'll just leave it to you guys because it's very, very handy to have your head around it. Scenario analysis is a bit more human in a way because it doesn't take things in isolation the way that the sensitivity analysis does. And it does have this more practical kind of approach. When I've done it, scenario analysis, one of the things I've found becomes a challenge is actually dreaming up these less likely scenarios. So I might do an awful lot of work to get the estimates, the best estimates I can for each one of the values that's going to go into the analysis. But then to come along and say, well, in fact, when I said that you're going to be getting, $2.50 per chicken that you produce if you're in a chicken farm, what is going to be my optimistic price? And will the optimistic price kind of happen in the same time as other things are going to move and so on? I'm kind of guessing these possible futures. My experience has been that actually guessing credible possible futures that are not what you personally believe is the most likely one actually becomes kind of difficult almost psychologically. And I've seen this with a lot of people using it, not because they go off like screaming heaps for a funny farm or something, but simply because there is a tendency to anchor your expectations. If you've seen a business getting along, making a nice, comfortable but significant income, and then the grandfather of the house dies, there probably isn't a temptation to simply let them go. But as I say, you just got to work out these less likely scenarios. Okay, scenario analysis. Assuming you can work out these alternatives, the easiest alternatives, you've got the most likely scenario. The easiest is to think of what happens if there's a severe economic problem, maybe sort of China stops trading with Australia or something. And you actually think, the China stops trading with Australia scenario, and you work out what that would look like. Our primary exports would probably change, perhaps our imports would change, our unemployment rate would change. And so you can build a scenario based on something like that, some way of making it concrete. You can also do, let's say, an optimistic one and a pessimistic one. That's not, that's kind of a more approachable way, a more tangible way of approaching it. But just dreaming out 20 scenarios is a bit tricky. Okay. Leads us on to the third way of dealing with risk analysis. And that is, what here is referred to as simulation analysis. A particular type of this is a thing called Monte Carlo simulation. And you'll probably hear from time to time people talking about doing Monte Carlo analysis when we're talking in the context of discounted cash flow capital budgeting decisions. By simulation analysis, I take out the problem that I was just describing with the scenario analysis. Remember, the scenario analysis came in order to consider all of the variables simultaneously rather than having them done piecemeal like sensitivity analysis. But the downside with scenario analysis is that it's hard to make credible alternate scenarios. Our brains aren't good at saying the future is going to be like X, but it also could be like Y, Z, T, Q, whatever. To get around that, what we do is we get a computer to simply randomly select or compute different scenarios, and computers being what they are, we can get computers to analyze lots and lots of alternate scenarios, and we can even automate and condense the results down to a single figure. And that's what Monte Carlo simulation does, or simulation analysis in general. What it does is that you get a computer to vary each one of the variables by some random amount, but within particular limits. And so you imagine if you had, what's an example of how you could do that? Simulation analysis. With the property, the property example, simulation analysis would possibly get the computer to allocate scenario after scenario, simply randomly saying the rent might be up, the rent might be down, the rent might be up by a little bit, just randomly produce a whole bunch of different estimates for the rent. And each time it does that, it's also working out a different possible value for the insurance and management fees and everything else. And it does these literally thousands or tens of thousands of times and takes a sum of them. Monte Carlo analysis or Monte Carlo simulation is popular, but oddly enough, it's actually not very robust theoretically, because there's no particular reason why most of the random scenarios is more or less realistic. And so Monte Carlo, as I say, it has its followers, but it also has serious theoretical defects. The fourth that we'll look at is this decision tree analysis. Decision tree analysis is where for each one of your variables or each one of your futures, you work out a probability and a value. And so you kind of put more depth into your risk analysis by saying, well, as you go through, you start off with one most likely set of data, but then this bit of data might move optimistic, pessimistic, or most likely. And so that means that the central set of data now has got 3 expressions. And then you might look at, when you take any of those, you might look at a second variable. You might say, oh, there's this other important variable, and it might take 3 values. And by the time you do that with 3 or 4 different variables, you end up with lots and lots of possibilities. And so this is where this idea, when you see this being laid out diagrammatically, it starts to resemble a tree, hence its name. Okay, they're the common ones. What do I recommend? Well, I would say the first 2 are theoretically and practically the most useful. Sensitivity analysis, moderately orderly economy is often as much as you need to do. And the fact that you don't actually capture all of the interactions between the variables is not so important, as long as we have a relatively well-behaved economy. Scenario analysis is still not a bad idea to do. I find that in practice, in consulting and situations where I've needed to use scenario analysis, working out the non-likely scenarios is, it's a bit of a mental challenge, because human beings tend to anchor on the most likely future. So they're my 2 recommendations. Okay, now I think we'll be going through some examples here. Sensitivity analysis on that, read through that, look at that example. Writing this up, not fabulously, oh, well, I'll let you work through it. Work through it as well as you can to the point where you can understand it and see what sensitivity analysis is telling us. Read through that, read through scenario analysis. Say Excel has a lovely scenario analysis tool built into it. We don't have enough time to do it, and it is a little bit of a tricky thing to operate, but once you got your head around it, very, very powerful. Okay, example, simulation. Just read through that. I don't anticipate you using that one. And I've already sort of spoken through that one. Example. I've talked about profitability index. What have we got here? I think we won't deal with that. These are I think we don't. Just read through them. Just read through them. A lot of the stuff is fairly. It's to deal with particular issues or particular sort of fine points. I'll leave you with those. We don't do those in practice in any great depth. You will be finding that if you go on to do further finance studies, we're actually using DCF practically, say in property investment and finance. We'll be taking scenario like sensitivity further, but the others we don't need to be too concerned about. Okay, I think that takes us to the end of these slides and for our week. So you'll notice that we've been doing more theory this week. It's got to do with practical examples, but we're looking at strategies and how to actually sort of use the tools. It doesn't mean that the maths isn't important. It's just that this week we've been looking more at the theory and sort of how to put it together. Okay, read the textbook, chapters 9 and 10 this week, important to go through. And definitely, go through the slides in detail. I know I was going to skip through them fairly rapidly, but I skipped through the ones that are just as easy to follow simply by reading them. Okay, have a good week, and I'll see you next week.
Thank you.
Most welcome.